Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 11th of June. I'm Daniel Lam, your host for the podcast. De-Dollarisation. That is a term that I've been hearing from time to time during my entire career in finance. The current discussion on this topic is perhaps the most intense that it has ever been for the last 20 years. This had to do with the uncertainties in US policies and the concerns about the size of the US budget deficit. While we believe that the US dollar is going to stay as the world's reserve currency, we do assign a 2/3 probability that the US dollar will weaken over the next 12 months. So how should investors be dealing with this? First of all, the D word, diversify. We want to diversify across different assets and also across different regions. And this is simple enough because assets from different regions would be denominated across different currencies. Moreover, some of the underlying assets would provide their own currency diversification. So for example, the revenues from US corporates could originate from non-US sources. Now, within equities and bonds, US dollar weaknesses can be positive for non-US markets. For commodities that are priced in US dollar, they can also rise in value to offset weaknesses in the US dollar. And gold is a great example of such. Now, within cash, you can identify currencies that can have a low or even negative correlation with the US dollar, and thus you can gain from a weakness in US dollar scenario. You can also look for currencies with relatively high interest rates to create additional source of return. Now, in our analysis on the balance of things, the euro, the Aussie dollar, and the pound sterling are three currencies that rank well on these criteria. Lastly, some investors may not be comfortable with the US dollar full stop, whether on the long side or on the short side, because they find Trump and the US policies to be flip-flopping too much. And that's understandable. So for these investors, they should be looking for cross-currency pairs, i.e. those that bypass the US dollar by pairing up two non-US dollar currencies. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.